Warren Buffett's road to making 30% returns on his money. Like and subscribe if you enjoy. Along being patient and swinging at the right times, Buffett has a few main principles to investing, which is assuring that the business that he is looking to investing in is doing well. He buys and holds, as well as understanding the business model. First, Warren Buffett looks out for the businesses that have a good business model, not necessarily a good stock value or history. In other words, if the business model is doing well, then the stock value will follow. Owning a stock means that you are owning a part of a business. So you need to look at the things that are going to give you a competitive advantage, be it high profit margins or an angle that no one else has. For example, if you had invested in Nokia instead of Apple in 2006, then you would have lost everything, not because Nokia stock was going down, but because there was a competitor named Apple with a huge competitive advantage. In simple terms, invest in companies that will dominate the future, not the present or past. 2, he understands the business that he is planning on investing in. The one thing that is consistent across the entirety of Buffett's portfolio is how he knows exactly what the company he is investing in is selling. Coca-Cola sells soft drinks and Apple sells mobile devices like iPhones and iPads. To make life more interesting, he says that you should invest in things that interest you. So if you like finance, then you could invest in things like Webull or Bank of America. If you like cars, then you can invest in Tesla or Ford. Before investing in something, you should always ask yourself, if I were to explain it to a 5-year-old, would they have no questions? That is a big test whether you should invest in something or not. Don't overcomplicate things. The models can be quite simple. Third, buying undervalue. Buffett says that every other rule on this list is useless unless you can buy an investment undervalued. So investing in Tesla when it was worth $2 would have been a great investment. Then you could ride that wave as long as you like. But if you bought it at $500, then that would not be good. When you invest in things that have a higher price, you get worried and scared a lot more. No company is worth an infinite price, even if the business model is the best. Finding the best opportunities at the right price takes a lot of time and constant analyzing the markets. Now, some people may find this interesting, and some may think this is the most boring thing in the world. Remember that you only have to be right once or twice in your entire career. Fourth, buy and hold. Warren Buffett didn't become a billionaire until he was 56. Why? Well, it's because he had many different stocks that he bought at a low price early on in his investing career and just held them. The value of the stock or investment goes up because of one great thing: compound interest. What a lot of people do when they invest is buy and sell at every new change in the markets because of fear and greed, but Buffett says that you should not do this. He says that compound interest is what will make you rich, and buying and selling will mess that groove up. Warren Buffett says that if you can't handle seeing the markets go up and down in value all the time, then you should have a low cost index fund that holds the entire market that you want to invest in. Warren Buffett has said many times over that most of the news is just noise pollution. This means that the majority of things out there are people trying to be heard or to grow their business, but in reality, a lot of this stuff won't help you. Be sure that everything you're investing in is stuff that you understand and not just investment that some random guy on YouTube said was good. Be sure to take advice from someone whose advice you actually act upon. This is why it is great to have many smarter people around you. That's the video for today. Like and subscribe if you enjoyed, and I'll see you next week.